Hey, good evening, my friends. It's that time again. We're back to, we've gone full circle, and so we're back to Tuesday. And as usual, each Tuesday at this time, 8 p.m., we have our video cast. So welcome. My name is David Etienne. I'm the owner and CEO of Etienne Business Solutions. We're a CPA and business consulting firm. And always need to remind you that after the video cast, if you feel like you want to, have a replay, or you may wish to refer it to another person who may find it useful, then you can always check my YouTube channel, which I suppose most of you will be jumping onto for the live video cast. My YouTube channel, Etienne's Place. And there you will find all these video casts that we do, so you can always replay, share, like, forward to a friend. And I invite you, subscribe, like, comment, let me hear your feedback. There may be things that you want to share with me that you would like me to expand or expound on. Whatever the case is, we will do it. So once again, welcome, and let's jump right into the subject matter. This evening, I want to spend a little time looking at Schedule C. Schedule C. Schedule C, as in that is a form that you have in your personal individual tax return, your Schedule C, okay? A lot of people, a lot of taxpayers incorporate Schedule C in their individual tax returns. Generally speaking, your tax returns is really a combination of several schedules depending on what is happening with you in terms of your tax life. Okay, so there are a lot of schedules in the tax returns, because what is happening is that your 1040, which is the main tax form, actually have lines, and those numbers you see at the relevant line may have the detailed workings in the background, and that detail is usually found on a schedule. All right, so the tax return is full of schedules. So Schedule C is one such. Let's talk about Schedule C. And more importantly, we want to look at some of the fundamental aspects of a Schedule C that I think you need to be familiar with. Now, a Schedule C is nothing more or less than a normal income statement that is inserted in your individual tax returns. It's an income statement. That's what it is. Because what it does, it has three broad categories. A section that shows whatever income you'd have earned, the expenses you incurred, and at the bottom is either you made a profit or a loss. Or it's also possible for you to break even. An income statement is a normal report that a business would produce. So you may be saying, if you are not running a business, why is it that you at times have a Schedule C in your tax returns? So I'll add to what I said earlier on, indicate that if you operate, and most of you would know this already, if you operate as a contractor, an independent contractor, then you would be paid not as an employee and be given a W-2. Normally, you'll be paid, and at the end of the year, you're given Form 1099. And that Form 1099 representing your income is what you're going to use to report on your tax returns. But as an independent contractor, you are entitled to certain deductions, expenses incurred by you in carrying out, in executing the service, the business, the activity for which you are contracted. So if you're a painter, You're not an employee, but yes, you're a painter, and so you are an independent contractor. You paint houses all over the place, or you may be contracted to a main job or a project, and you're paid throughout the year. So at the end of the year, you're given a 1099 to show all the income earned as a contractor. And so that is what you bring onto your Schedule C as the income. Naturally, you'd have business-related expenses. You deduct those expenses from the income. You come down to your bottom line. Profit, loss, break even, whatever the case is. So that is your Schedule C in a nutshell. That's what it is. That's what it is. Let us shift, however, from that Schedule C that an independent contractor is using. So basically, it's not that he actually has a separate business, just that because he provides his services as an independent contractor, then whatever payment on a Schedule C is reported in that manner. Let us look at a sole proprietor. Okay, a sole proprietor. So this guy decide, okay, I'm a painter, but I'm going to definitely start my own little painting business. All right, cool. So I'm going to set up my thing and maybe get it properly registered, get your tax ID number, the works. And so you are official, you're a painter, and you're providing your services, painting, whatever you do, houses, industrial, doesn't matter. Now, at the time of making the decision to formalize this business, then you'd recognize that there are some what we call business startup expenditure that you have to undertake. Yes, so using the painter example, you're going to buy some tools, some spray gun, some, whatever tools that painters use, those machines to do whatever, maybe to sand down surfaces, you name it. So what you'll find is that your initial expenditure is usually directed at you acquiring the equipment that is needed to carry out your painting services. Note, I am not talking about buying paint as supplies to utilize on a particular job. No, we're talking about you buying your equipment that is going to be used multiple times over a number of years. So your initial expenditure will be you acquiring these equipment, because without the equipment you cannot provide the service. Quite likely, as most small business or businessmen have to do, you may utilize your own funds. Naturally, okay? You use your own funds, so you put your money into this business. So you put your money in to acquire the spray gun, the this, the that, the other. Now, it is very important to decide how you want to characterize this initial money that you put into the business. How do you want to define it? Because based on the definition and the treatment that you apply to this initial funding that you provide, the treatment for tax purpose and otherwise will be different. Let us use a number. So you decide, okay, I'm going to put in, and if you notice, I'm just loosely saying put in. I'm not ready yet to use the exact term. I'm saying put in. You decide you're going to put in $10,000 into the business. Okay? You're going to take $10,000 of your money and you're going to put that into the business. Now come the characterization. You need to determine, is this $10,000 an investment in the business, meaning that this $10,000 represents the initial capital, the startup capital of the business, as opposed to you making a loan Follow me? You making a loan to this business of $10,000, then the business will use that loan to acquire the equipment, etc., which then becomes the capital invested into the business. And so by acquiring these things, the business don't end up having what we call assets. The equipment, the tools to carry out the work. So let me just repeat that. When you take $10,000 of your money and you put into this business, you can either put it in on the understanding that this is your investment in the business, so it becomes the capital of the business. As capital, you intend that this money is going to remain in the business more or less, I just use the word into perpetuity, okay? You put this money, it is you pump some blood into this business via $10,000, and you intend that it will remain in the business to grow the business. On the other hand, if you put this $10,000 into the business and you treat it as a loan to the business, then what you're saying is that as soon as the business is up and running and has started to generate, income, good income above its expenses, and we'll come to that, then you are definitely going to look about recovering your loan. Okay? So you put $10,000 in as a loan to the business with the intention that when the business is able, you're going to recover your loan from the business. The prior understanding is where you say, okay, I've invested capital and that's it. Now, there's a subtlety about these two things, and it is more pronounced in large organizations, but the principle is still applicable here. If you treat that $10,000 as capital, okay, your investment in the business capital, then the benefit or the returns that you will receive from this investment, from this capital injection, is by way of what we call dividends. So as the $10,000 work and generate revenue, and the revenue is greater than the total expenses, that leaves a profit, then you find that some of that profit will be distributed back to you. And we could call that, in the bigger picture for large corporations, that is where they would determine, okay, since we have surplus income, we can now make dividend payouts to those persons who invested in this business, who are called shareholders. The same principle applies in your case. If you say, I'm actually investing this money, then you're saying, okay, you're going to be thinking of, okay, I need to get a return on my investment. On the other hand, if you treat this $10,000 as a loan, and let me also say, you recognize also that this dividend or this return on your investment is only not just possible, but applicable if the business has generated surplus income. So if the business make $100 sales and have $80 expenses, so it has made a positive $20 profit. Now it is in a position to make these dividend payments. And if you put in your money as capital, then you would be, entitled to some of that. But if you notice, the ability to receive this dividend is based on the company making this surplus income in excess of expenses. If you had treated that money as a loan does not receive dividend as its compensation. A loan receives interest as its compensation. So if you made a loan to this business, you are entitled to receive interest on your loan. interest on your loan is not dependent on whether or not the business made a profit, because interest expense is a normal operating expense of the business. So go back to the big corporate picture. Shareholders who have invested in the business by buying shares can only receive dividends if and when the company has surplus income in excess of expenses. However, individuals and entities that make loans to the corporation, they are entitled to interest payment. And their entitlement to interest is not based on whether or not the company made a surplus, made a profit. No. Because in determining whether or not the company make a profit, you have to say income minus all the expenses, and the bottom line is profit or loss. But remember, the interest is part of all these expenses. So the interest figure is calculated and deducted before you reach to the bottom line, that is the profit. So as a loan, this person would be entitled to interest. So come back to the painter guy. In the strict sense of the word, if he puts in the $10,000 as a loan to the business, then he is entitled to interest payments. Yeah, because remember, it is fortunate that he, the owner of the business, was able to pull $10,000 from his personal savings. If this guy did not have $10,000, maybe he would have had to go to a credit union or somewhere to borrow $10,000. You will agree with me that the bank or the credit union would expect to receive interest on that loan. So the principle of interest on loan disregards the source of the loan. If the loan came from the credit union, interest is due. If the loan came from the bank, interest is due. If the loan came from the owner of the business, interest is due. So going back to where I started, when that businessman, that sole proprietor, that entrepreneur decide, I'm going to start a business and I'm going to put in $10,000 into this business, it is very important to determine how he wants to characterize that thing. Capital or loan. Moving right along. Let's see how this ties back into our Schedule C discussion for tonight. Often, a client will come and he'll say, okay, so now it's 2023. He'll come and he'll say, last year I started a business. And I made $10,000 revenue. Fine. But I spent $20,000 last year, which is true. So he's coming expecting to report on a Schedule C $10,000 income, $20,000 expenses, negative, a loss of $10,000, which then will act as a tax write-off. Maybe not the full amount. We will speak on that a little in a minute. But the basic principle is that the loss is shown on the Schedule C that will go to give a sort of tax write-off. Okay? But that's not quite true. Because that money that was put into the business initially as startup money, whether it was put in as a loan or it was put in as an investment, the fact is, once that money went to the business, let us say it was put into the business bank account, the business now start to spend that money. It would have spent some of that money to acquire these things that we mentioned, the equipment necessary to carry out the business of painting. Those expenditure are called capital expenditure. Those expenditure are for the acquisition or for the buying of what we call assets. Assets. Which is totally different from the use of some of the $10,000 to buy supplies, paint, sandpaper, tarp to cover the floor. Those things are what we call consumables. They are things that we buy to execute the job for which we are going to earn the income. Okay, so those are operating expenses which are different, separate and apart from the monies that were used to buy the equipment, which would be the fixed asset. And maybe the guy to buy a pickup truck. Yeah, he has to transport his things all over. So he buys that as a pickup truck, buys some equipment, etc. Using the same 10,000, let us say that 7,000 of that money went into buying pickup truck. I know you say, what kind of truck is that? But that's fine. Pickup truck, equipment, etc., etc. And then we assume that the other 3,000 was used to buy general supplies. Okay? So he really spent the 10,000, but 7,000 was the acquisition of assets, 3,000 was the acquisition of regular supplies to execute the jobs that that he's on. Then now, let's say that at the end of the year, he looks and he said, okay, I made $15,000 income, $15,000 revenue. So he's thinking that I made $15,000 revenue. I spent $10,000 in the same 2022 year. And so I'm going to show on my schedule C, 15,000 income. Then I'm going to detail all the money that I spend that comes up to 10,000. And so I'm only going to show a little profit of 5,000. 15 income, 10 payout. So 5 is the profit. Wrong, 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 wrong. We won't get into any, too much of a bookkeeping principle, but there's something that we call the matching principle. The basic principle. All it is saying is that you are operating and you are earning income. But in order to earn this income, you have to incur some expenses. So there's a match between the earning of the income and the costs that were incurred in order to earn the income. So just keep in mind that $3,000 that was used to buy supplies, paint and sandpaper, etc., etc., those are expenses directly incurred in order to earn that income. We're going to say, but David, the blower and the truck that he has to drive onto the side also contributed to him earning the income. And I say yes. However, the truck and the blower and other equipment, other assets that he bought will not only be utilized in 1 year. They will last for the next 4, 5, 6, 7 years. And so the life and the usefulness of these assets, equipment, truck, will extend over a period greater than the year in question. So you could never expect to take all of that $7,000 that was used to buy these things and write it all off in 1 year, when you will be able to use the truck and the blower and the other assets in years 2, 3, 4, 5, 6. So basically then, we say we have to find a way to apportion the cost of these assets, equipment, truck, etc., over their life. So, and these things were predetermined. So if it is assumed that the the tax life or the useful life or the depreciable life, whatever, of the truck or the sander or the blower is 4, 5 years, etc., then that cost, let us say that it was the 7,000 that was used to buy all these things. Then that 7,000 will have to be spread. The recovery of that $7,000 expenditure will have to be recovered over several years. You cannot just expect to be able to write it off in the first year of business. However, the $3,000 that was used to buy supplies, you know, the paint, the little brushes that you dispose of, etc., those are the operating expenses. That being said, using the same $15,000 revenue that you generated, from which you thought you could have just deducted $10,000 expenses and only have a $5,000 profit for tax purpose, you recognize, no, it doesn't work that way. Yes, $3,000 will be a direct write-off, but of the other $7,000, you may find that you can only write off, say, $2,000 of it in that first year, another $2,000 in the second year, another $2,000 in the third year, and that's how it's done. So what catch a lot of people off guard is that they end up with a much bigger profit than they thought. Because when it is explained that you cannot just write off all the cost of those assets in the first year, then they realize, oh wow, well in that case then, the amount of expenses that I can write off is much less than I thought, and so my profit is going to be so much larger. Okay? Very important, very important. Now, there's a line on your Schedule C, very clear to see, it speaks to depreciation. On all that line it does is to say, okay, of the total money spent to buy this truck, this blower, and other equipment, which are called assets, this is where the portion, the piece of it that can be written off in this year, that is the line on which it will be reflected. And how do you come up with that number? Very simple. Once you put the information, the truck, the cost of the truck, and the category of asset, etc., all those things are in the Schedule C, in the tax software. It tells you how much depreciation, how much of that cost you're able to write off in year 1, and then how much in year 2, year 3, year 4 as you go along. Okay, so it's not a case of you being able to write off everything until you're gonna dump it on your Schedule C and get a write-off. Now, there's a provision in the tax law, and it's referred to as a Section 179 deduction. Okay? Section 179, exactly as it says. In the tax code is full of sections. And one of the sections is called number 179. Okay? So you have, there's a provision there. And what is that saying? That is saying, follow me carefully, in the first year, and we're going back to what we said earlier on, now it's 2023, you're preparing your 2022 taxes, and we are going to assume that you started business in 2022, and so you acquired this truck, this blower, this equipment, this whatever sander in 2022. So it's the first year you're going to be reporting these things on your Schedule C. The provision of this Section 179 states that, and I'm just paraphrasing, that in that first year that you just put the equipment into operation, you are allowed what can be called an accelerated depreciation, meaning simple. It means that whereas normal depreciation would be to take the cost of the assets and spread them over 3, 5, 8, whatever years, and equally divide it up, we call a straight line depreciation. That section is saying that in the first year, and it is only for the first year, in the first year that you put this into operation, you are allowed to take a lump sum deduction. So going back to the numbers, you spend $7,000 to buy a truck, blower, all the assets. Normal depreciation, just for argument's sake, maybe would allow you only to deduct $1,500 of that through depreciation in this first year. But the section 179 is saying, no, if you so choose, we will allow you to deduct a much larger figure. So let us say you decide, okay, so I'm going to go for $5,000 of that $7,000. So, okay, you jump on it and you say, okay, I'm taking $5,000 deduction in that first year. Having taken $5,000 deduction in that first year, then the balance that is left to be spread would be $2,000. Because remember, the total asset purchase value was $7,000. You took a lump sum deduction in year 1 or 5. So you have $2,000 to go, and that will be spread over the remaining life of these assets. And that sounds like, that's wonderful. And the answer is yes, and the answer is no, and the answer is maybe so. Okay? Quickly. Very often, a new business, a startup business, usually do not generate that much of an income in the first year. Okay? You're just starting, just getting yourself sorted out. And so it is reasonable to assume that in years 2, 3, 4, as the business matures, it will start to, generate more and more and more revenue. Mark you, yes, its expenses, operating expenses will also increase. But the point is, the more revenue you generate as the years go by, is the more you would have liked to be able to have as much write-off as possible. Especially, and this is the key thing, people, especially if this write-off did not require to spend any money out of bank or out of pocket. Because remember, depreciation expense, although it is treated as a business write-off, just like utility bills, just like telephone bill, the beauty about a depreciation write-off is that other than you are having spent that initial money to buy the asset, when you're taking the yearly depreciation, those depreciation figures are not represented by you actually spending additional money from bank. So let's go back to this section 179 deduction decision. It may be unwise for you to just take a lump sum deduction in that first year under that section 179 provision when your income wasn't that much, so you did not really need that much of a write-off to be able to minimize a potential big tax bill. No, because your income in that first year was pretty low. So if you take that big deduction and take that big write-off, you almost like squander that opportunity. You're going to say to me, but if I ended up with a big loss, it will be carried forward. We'll come to that. What I'm alluding to is you may find that spreading the cost of these assets through normal depreciation for the next 2, 3, 4, 5 years may be worthwhile. Will come very handy in years 2, 3, and 4 when you actually start to generate higher levels of revenue. And so you wish to have more write-offs, especially where those write-offs are book write-off, paper write-off. A depreciation write-off is not, if you have a depreciation write-off of $3,000 this year, it is not because you had to pay out $3,000 for depreciation. No, the initial expenditure, had occurred when you bought the equipment. So just a quick recap. Section 179 deduction is very good. It's very helpful. But then people tend to squander it in that because you can get it. And you can only get in that first year. And you say, boy, I don't want to lose out on it. You just jump and you take it. And you apply it to your thing when there was not even much income that needed that big write-off to prevent a big tax bill. So you have utilized 5,000 of the 7,000. And then in years 2 and 3, you end up with a lot of revenue and you say, oh my goodness, I'm going to have a big profit, which is good, but I'm going to have a big tax bill, etc. But if you had that depreciation to spread for the 3, 4, 5 years, it would have served you better. It would have been much more useful to you. It would have significantly cut down your bottom line, hence your taxable income. And it would have reduced the taxable income or the profit on that Schedule C without you having to spend additional dollar, because remember that depreciation write-off is a book entry. It does not require to pay out that money. Nobody draws a check and pay out to depreciation. Okay, that initial expenditure was already undertaken when you bought the assets. Key. So if you notice, I'm mentioning these things because I want you to get an understanding, because all these things are going to end up on your Schedule C. All these things will inform the way you approach Schedule C. All right, and not just a place you say, okay, it's a good opportunity for me to just throw this and throw that, and no, you need to approach it with a level of understanding to say, okay, what does it represent? How does it impact my overall tax picture depending on how I approach it? Starting from how you treat that initial investment to how you decide to do that bulk write-off or gradual write-off of the cost of the asset, to you recognizing that all the money I spent in that first year is not something that I cannot deduct on a Schedule C in the first year. Okay? And that is where some of that money was used to procure things that are long-term, that have a useful life that extends beyond a single year. So they are fixed assets to be utilized year after year after year after year. Okay, that is it. So very, very, very important. So other than that, and of course, I mentioned earlier on the whole issue of interest versus, I still call it dividend. You might say, sole proprietors don't really receive a dividend, etc., etc. But the principle is the same, because at the end of the day, when that little business makes a profit, it is saying that yes, all that profit is really belonging to the owner. That is true. So you may say it doesn't make much of a difference there. But when it comes to you treating your money as a loan, it means that you're entitled to your interest as compensation, as payment for the loan that you have made, which will have the effect of reducing the bottom line, where the tax will now, which will now flow onto the 1040 to be taxed. So that again is critical to look. I'm just seeing there's something else I need to touch on. Oh yes. So, and remember to, well, not remember, bear in mind that yes, year one, you did not make much of an income, and so you have your normal operating expenses. And let us say that you made a decision that yes, I'm going to go for my Section 179 deduction, and although I do not have a lot of income and therefore I would not have any big profit to have a big tax bill, I still don't want to pass up the opportunity to deduct a big chunk of my asset cost in that first year. You may have made that decision. Now, if you made a decision, it means that with that low income in that first year, you're going to have a big negative. You're going to have a big negative. The Schedule C is going to show a big business loss, operating loss. This operating loss will transfer onto your 1040. And assuming that you had, because some people, although they have that Schedule C, they would also have normal W2 and W2 tax liability. So if that is the case, yes, that big loss will transfer over onto the 1040, and that loss will help to mitigate, right? Will help to reverse or soften some of the tax blow that you'll be experiencing from the W2 and the whatever else. So that is there. Again, very important, if your loss was, say, $20,000, there is no guarantee that you will get a tax write-off in this year to the tune of $20,000. Why? Because the amount of write-off that you get is going to be directly linked, among other things, is going to be directly linked to your other income that is generating those tax liabilities. So you may find that of your 20,000, maybe 5,000 of it is the maximum that will be allowed to be applied as a write-off in this year. And you're going to say, oh yeah, but that's not fair because I actually had a loss of $20,000. How can it be only $5,000? I say, hold your horses. No, you're not losing it. Don't be fearful of that. That other 15,000 that was not applied in this year, it is not lost. You're still entitled to it. All that will happen is that it will be taken to future years. So in year 2, when you prepare your taxes, some of that loss that was not utilized will now be applied to your tax position of year 2. And let us say you had 15,000 left. Let us say that another 5,000 was used. So you still have 10,000 unutilized. That will continue into the next and into the next year. So you always have the balance of unutilized business loss as a tax write-off ongoing. And based on the rule, you're allowed to take it forward up to 20 years. For clarification, it is saying that after year 1, any unused loss, the tax benefit, tax write-off of any unused loss will be carried forward to year 2. Then you utilize some more. If still a balance, goes to year 3. Then you use some of it. Year 4, year 5, until you use it all. Now let us assume that, for whatever reason, you come to year 20 and you still have $1,000 of that loss from way back, still unused up. Then that piece, that $1,000 will lapse. It will be gone with the wind because you're allowed up to 20 years going forward to utilize the loss that you were not able to utilize in year 1. Okay? Lastly, I'll say on this, you may also note that you racked up a big loss in year 1. You could not use all of it. So it's carried forward for 20 years. But if in year 2, you rack up an additional loss, then you're actually adding to the stock of loss that you have. But bear in mind, if let us say for the first 3 years, stack up losses, each of those years have their own 20-year countdown regime. So for year 1, use up some of it, 20 years down to use all of it. If in year 2, you rack up some more losses. For year two's loss, year two is the first year of that loss. So you, whatever. If in year three, you have some more losses, then that year three is the first year for year three's loss, and you'd have 20 years down. So you may find that if you should prepare a table, you would have losses in year one, let me see, flow to 20 years. Loss in year two, flow to 20 years. Loss in year three, flow to 20 years. And so you'd have different end points, different 20-year points for the different losses. This is just a principle I'm actually sharing with you. So that's about it. I just wanted you to see, because the Schedule C is more than just filling out the form. It's very easy to fill out the form. As I said, it is nothing more than an income statement. Okay? You just throw the income, put the expenses, the telephone, the utilities, the repair, maintenance, take this number, minus these numbers, come to a bottom. It's a simple mechanical exercise. The understanding of the implications of the treatments is what is important. So that will help you to decide, should I or shouldn't I? Is it wiser to refrain, abstain, delay, or should I go for it? Should I classify my money put in as an investment, or should I treat it as I'm making a loan to the business? You know, all these are things that need to be thought through, and that is where tax planning comes in. I mean, tax planning is a big, wide world of stuff. But as far as Schedule C is concerned, you could take one of two approaches. A form preparation approach, fill out the form, put the number, get the result done. That's all. You just fill out a form. Or you could take a tax planning approach, a strategic approach to your Schedule C, which will do two things. Help you to be in compliance, yes, because the IRS will definitely look at. You may have heard it said that Schedule C, tax returns with Schedule Cs have the highest, or is one of those things that carry the highest incidence of tax audits. And you can see why. You know, it's easy for Schedule C to be abused. And sometimes it is not intentional. It is because of a lack of understanding. And it's a pity that the preparer who is Marco, assuming it's not self-prepared, but it's a pity that the person who is holding him or herself out there as a knowledgeable person would not be able to get and say, oh no, can't write off all this thing, can't it, kind of thing. But yeah, it's very important to see from a point of compliance and also from the point of proper tax planning as far as your Schedule C goes. And I close by saying this. A lot of taxpayers, they are employees, meaning that they have a job somewhere, they get their W-2 income kind of thing, they have their normal taxes deducted through payroll, withholding, etc., etc., etc. But then they, people are industrious, so they have skills, so they decide, I will do my thing. I'll do my thing. So I may decide I'm going to do some lawn care in the evenings and on the weekends. And so what they do, they buy a mower, they buy like a pickup truck, they buy some tools, etc. And they start a business. And so come tax time, they are now doing more than just reporting a W-2. They are now reporting income from that activity, which has to be shown on a Schedule C. And that is where the understanding needs to be at, so that you're both in compliance and you're making proper strategic tax planning moves and decisions. Okay? That's my bit on. I thought I would just share that with you about your Schedule C. So think about it, and if you have not yet done your taxes, or as you plan to structure yourself properly and do the right thing, then I hope that my little tidbit here will help you along that path. So this is David Etienne, Again, check out my YouTube channel, Etienne's Place. You'll find a whole list of videos on all different manner of business, tax, financial planning, business development, you name it. It's all there. It's all there. So I invite you guys to check out the channel, leave a comment, share, of course, subscribe. I want to subscribe so that once we have new stuff coming out, you'll be alerted. So subscribe, share, like my page. Even if you don't like me, the person, like my page, and leave your comments. Leave your comment, because as I like to remind you that your comments and your feedback tend to feed into my thought process, and it tells me, the kind of things that people are thinking about, the concerns that people have, and maybe some of the subject matter that you guys may want me to speak on. Because as usual on Etienne's Place, what we try to do is to take the most complex, I'm not saying this is complex, but we try to take the most complex of stuff, break it down into chewable, digestible bits and pieces so that you can make good of it. So catch you again until next Tuesday, when we'll be back here at 8 p.m. with another Tuesday video cast. Okay guys, have a wonderful, wonderful rest of the week.